Hi everyone, this is Jathu from Property Framework, and today I want to talk about markets that you should avoid if you are after short-term growth. Now, these markets are not the ones that you should always avoid, or permanently avoid. You're just avoiding these markets at this point of time because these markets are not going to give you that short-term growth that you want. So, how do you interpret this using data? How do you read the data and know that you should not invest in these markets? That's what this video is all about. And the markets that we are looking at, these are really strong markets with strong economies, diversified economies, good population numbers, and a wide range of infrastructure projects lined up. However, the property market itself, it's not doing too well, and you can read that from those data trends. Now, if you were just after long-term growth, of course the markets that I'm going to talk about, they will give you that long-term growth like any other property market. But if you're someone who is after short-term growth, then it's important that you know how to read the data trends and avoid these markets, because you might end up not having any growth or having negative growth for the next few years. So let's look at how to interpret this data. Let's start off with NSW Wagga Wagga. So Wagga Wagga is a major regional center in New South Wales. The median price is 625,000. So that's the median price. There are markets priced well under 625k and markets above 625k as well. Median rent is 477 per week, and the rental yield is just under that 4%. Now, the indicators that's telling me that this market is slowing down is number one, the days on market. So the days on market is telling me how many days a listing is sitting on realestate.com.au. So if you see that it's sitting longer over time, that means the market is kind of cooling down. So what you see here is that in 2010, it was around 40 days, but right now it has moved up to around 60 to 70 days. So properties are selling longer to sell in Wagga Wagga. And then the other good measure is the inventory levels. So inventory, to give it in very simple terms, if you have 10 properties listed on the market and there's nothing more added in, and in that suburb 10 properties sell every month, then the inventory is 10 divided by 10, which is 1. Let's say there are 100 listings on the market and no more is added in, and in that suburb there are 10 properties that sell every month, right? So that's 100 divided by 10. The inventory is 10, right? So the lower the inventory number, the faster the suburb is moving, and faster the property market in that suburb is moving, right? So anything under 3 months of inventory is considered to be very healthy and a strong market where prices are moving upwards. Above three, it's um, the market could be flat, or property values could be even reducing in value, right? So what you can see in Wagga Wagga is it's been around that 4 and then has moved up towards that 6. So it's fluctuating between 5 and 6. So inventory levels are not showing any signs of reducing. They are above between 4 and 6. And then the next one here is the listings, the number of properties that are listed. There's no sign of them reducing. You want to see a reducing sign, especially in a market that's picking momentum, but here it's going the other way around. It's moving upward. So there's more properties coming onto the market. So what this means is that over the next 2 to 3 years, price growth is going to slow down in Wagga Wagga, and you're not going to see really strong growth. So if you invest in Wagga Wagga now, you won't have much growth over the next 2 to 3 years. The next one is Albury. Now, Albury is also a very strong regional center in New South Wales. Like I said previously, this is economically really diversified. There's a lot of projects happening there. And over the long term, Albury is, in fact, a really good market. But right now and over for the next few years, the short term, the Albury market isn't looking too good because number one, you can see days on market increasing significantly. over the last couple of years. Now we have moved almost to around 60 days on market. The inventory levels are moving upwards. It's around that 4 and 5. It's moving between 4 and 5. There's no sign of it slowing down, and listings is not reducing. Listings is it's slightly moving upwards, right? And the important trend here, this one, this graph here, is the auction clearance rates. The auction clearance rates have significantly dropped in Albury, right? With a median price of 689K. And the rental yield is it's a bit low in Albury. It's around 3.34%. Um, it doesn't look really good for Aubrey. The market over the next few years is doesn't look too strong, right? Let's move on to the next one, which is another market in NSW. So this is Dabo, and we can see days on market is kind of steady, so that's not too bad. But what's interesting here is the inventory has moved up from 4 towards 6. Listings also are showing a steady increase in double, and auction clearance rates have been steadily reducing. Median prices are 597K. Rental yields are just around that 3.5. With the data trends that I'm seeing here, it doesn't look like the double market is going to do well over the next couple of years. Moving on to another big market in New South Wales, this is Coffs Harbour. So, like we saw with the other markets, the very obvious trend is that the days on market increasing, which shows that the property market is slowing down. Inventory is not too bad. It's around it does reduce, but it's still fairly high. It's around that, sitting around that 6, which is fairly high, and listings are kind of stable. So there's signs showing that this market is not very heated. It's quite it's cooling down, or kind of a really flat market. Nothing much is happening here, which means that over the next couple of years, there's not going to be much price growth in this market. Okay. Now let's move on to Victoria. We go into another major regional center, which is Geelong, right? So what you can see in Geelong is days on market steadily increasing. Inventory levels are still significantly high. Now, when a market is moving towards gaining momentum, or if it's a market that you can consider for short-term growth, then you would see these inventories gradually dropping over time. But we're not seeing that happen here. We're just seeing that, just moving up and then just being constant, which is not something we want to see. And even the listings here, it's not showing any signs of going down. It's just steady and then moving up. So Geelong, even though it's fundamentally a very strong market at this point of time, the data is suggesting that price growth is slowing down in Geelong. In fact, it has recorded negative growth over the past year, and over the next couple of years, it's the price. There's not going to be much growth happening here. Of course, this could change, but it's not going. It's going to be a while before that change happens. Okay. The next one is Victoria again, when we're looking at Ballarat. Ballarat is another major regional center in Victoria. What we can see here is a significant increase in the days on market in the 2020s. You can see that the Ballarat was a heated market with just days on market just being 20, and you can see the shift here. Right now, this is around 60 days, so things are really slowing down in Ballarat. The inventory levels are moving up, listings are moving up. Over the last year, it recorded negative price growth of 6%. That means median price dropped by 6%. And looking at these data trends, there's no sign showing that the market is recovering. So this either this negative trend could continue, or we might see that the prices just being flat and nothing happening. So not the greatest of markets to invest if you want short-term growth over the next 2 years. So that pretty much sums up the what I wanted to cover today. So you can see the commonality in all these markets is they are major regional centers, but we are seeing days on markets increasing. We are seeing the inventory levels rising. We are seeing the listings picking up in these markets. What that means for price growth is that price growth is going to slow down, or it's starting. It will be moving into negative territory. So As an investor, if you're looking to build out a property portfolio, if you get into these markets, you might have that. It's the opportunity cost of getting into these markets which have no growth for 2 to 3 years, right? So that is going to slow down the speed at which you're going to build out your portfolio. And that is why we need to look for markets where we're seeing reducing trends, like reducing trends in days on market, reducing inventory levels, um, reducing stock levels, reducing vacancy rates. These are some of the signs that we want to look for when we want to look for short term growth in these markets. Right? So, this video was just to explain to you how to read and understand the markets just by looking at some very simple data. I hope you found this useful, and I'll be preparing more content like this in the future. Thank you.